I want to thank you all for being here. My name is Aburime, and I'm happy to be with you. Dr. Sheyi, thank you so much for the opportunity to meet your community. And when you were, describing me, I was wondering whether it was me you were talking about, because, we are colleagues. It's nothing like a senior friend or whatever. We first met to have this conversation when after our PhD, coursework as colleague, we decided to have some session together, and the conversation led us to, discuss how to create wealth. And by the way, just to quickly say it from the onset, there are multiple vehicles, to create wealth. I just happen to, love the Nigerian BIOS because of the huge potential that is in there. I don't have, details of the, if a proper introduction of almost all the participants. I want to presume various investment outlets, and it's also likely or possible, and some of us also. So maybe in the course of this session, we'll do a little interaction. I'm just going to be moderating the session and also give room for, ideas sharing, comments, and maybe experience sharing for those of you who already playing the market. I have been in the Nigerian BIOS for more than 2 decades. Precisely when I started, as soon as I finished my NYC, that I was actively involved in the Nigerian Stock Exchange. So I've, had to burn my figure. I was actively in the market during the meltdown in 2008. I had some, losses, but I've also had some gains. And as you are aware, for those of you who are financially inclined, the critical thing is to make more revenue, make more profit and losses. And so cumulatively, you can smile to the bank. And as you do this business, you get to have some hands-on experience on how to get it right, knowing how to select your stock, knowing when to come into the market, knowing when to go out. So the bottom line is actually buying cheap and selling, with profits, as well as trying to reduce your loss as much as possible. Let me also warn quickly that when you play in the Nigerian BIOS, your capital is at risk. It's at risk because no matter how savvy one is, it's unlikely that you'll be able to beat the market always. There are so many factors, a tapestry of factors that work together to influence the prices of equities and instruments that are listed in the market. Some of them are things you can, work on and look at easily and able to decipher them. There are some that will just be based on spur of the moment news, shocks, unexpected information that emanates from significant players in the market, including regulators' pronouncements, and even global happening that could affect a local economy via the contagion effect. The Treasury in the US could, start to engage in aggressive quantitative easing, and then you see some investors trying to analyze the impact in the global economy. Just that reaction within that period could have serious implications on the prices of equities in the market. So there are so many factors that could come to play. But the critical thing is being able to have an investment objective. As a certified analyst, one of the goals when we want to interact with potential investors is, first of all, to assess what their investment objective is like and their risk appetite. And that is why I said a quick run through of the various participants, their outlook for investment would have given an idea, and everybody differs in terms of risk aversion, in terms of orientation, in terms of horizon, timeline, extent of a willingness to invest into the long term, those who are short-term investors, those who just want to build capital towards a particular goal and all that. So having an idea of what we want will normally be what we take into consideration when we are doing a consultancy such as this. We also, if we progress, maybe not today, we'll be willing to share some ways of analyzing the technicals. You see some stock, they have behaviors. They have behaviors that are driven by technical sentiments that are not necessarily captured in their financial statements. Almost everybody that has some idea of finance can pick up a financial statement and look at the price-earning ratio, look at the return on equity, look at the EBITDA, look at some metrics that are pointers to performance, that are pointers to ongoing consign and all whatnot. But there are other technical analyses that are not necessarily reflected in the financials. So there are tools that enable us to be able to monitor those tools, looking at, for instance, like buying signal, how strong those signals are. Is it a buy or sell signal, entry price analysis and all whatnot. But those are, details that can be organized specifically for, well-defined sessions that are made for this purpose. The world of stock is very wide, and it's unlikely that a session of an hour, 45 minutes will be able to capture everything. So at best, I will just be appetizing some of you on maybe trying to whet your appetite and giving you reason to, take a look at the Nigerian BIOS as an avenue to create wealth. There are some that I will be, intensifying your desire. Maybe you're already in there, and after the session, maybe you want to, take a deeper look. While there are some who, might be at the end of this session being first-time investors. So I presume that we have categorization among us. So today we are going to be looking at some of those things we consider when we want to pick stock that have massive growth potential. Maybe that is used in a very loose way. Naturally, you have value stock, you have growth stock. You have stock that the basis of your investment is just how you gain capital appreciation. There are some that are more or less mainly for income, like the regular dividends they pay, and you want to see them like stock you want to hold into the long run because you feel the dividend yield is unmatched by any form of fixed income securities in the market. Today, the GITES security measured by the Nigerian Treasury Bill is returning an average of between 19 to 21%, depending on the tenure. Over the last couple of bids, that has been the range. There was a moderation, just the last one. And that is largely because of some of the policies of the Nigerian CBN trying to manage the FS market. And so because there was so much liquidity in the market, there was some moderation in the instrument yields, 1%, 2% basis point downward. But when you compare the fixed income market yields with the Nigerian inflation rate that is already above 34, basically it's a negative return, okay? We'll come to that because sometimes people overemphasize the concept of negative return and discourage people from investing in a particular vehicle, but experience have shown that you can actually beat inflation if you know how to play compound interest, which in itself is a massive and miraculous instrument of creating wealth. Your ability to be able to, compound your return is what this session, will be about. As we progress, I will be introducing you to this calculator. I'm sure many of you must have seen it. Can we see this calculator on the screen? The HP 12C Platinum. Can we?
Yes, sir.
Okay, excellent.
Yes, we can see.
Yeah, so...
yes, we can see.
Exactly. For those of you that are financially savvy, maybe you already have this. If you don't have it, maybe after this session, you want to take some investment, just buy this calculator, because if we were to meet in subsequent session, I'm going to be telling you how right from your home you can even calculate, what your future values will be, and you can have a line of sight as to when your money will double. As part of just setting the tone, I love the concept of Rule 72. Your money. So the rule is simply knowing the yield in terms of percentage. It's easier to use a fixed income instrument to illustrate. Maybe you have an investment that gives you, let's say, 10% for ease of calculation, gives you 10% annual return. It could be a dividend yield, it could be an equity you invested in, and they give you average of 10%. Let's assume there is no capital appreciation on the principal, or it could be a fixed income security like a Nigerian federal government bond or a Sukuk investment or a treasury bill, for instance, and it gives you 10%. So it means 72 divided by 10 is 7, means an average of 7 years, 2 months. Your money will double. So if you invested 50 million to be 100 million, 100 million, it will be 200 million in 7.2 years. So what that means is you can make up your mind how you want your future value to be by deciding the kind of investment you want to embark on today, the present as in today, and you have a line of sight as to when your money will double. I love when it doubles within 3 years, maximum 4 years. I love that when it happens that way. So it's a portfolio approach. If we talk about stock exchange and what you can make from the Nigerian bourse, my general baseline advice would be build a portfolio. And a portfolio is an amalgam of different securities. You have equity, which is shares. You have bonds. Then you have maybe other alternative investment like, real estate. So as we progress, some people may want to have commodities and currency. Maybe you want to have currency like the greenback, the dollar. You want to have commodity like gold or whatever. But for starters and mean starter, it will be sufficient to have a mix of equity, the debt instrument, which is the bond, and maybe property. It's always better for diversification benefits for you to think, portfolio approach. So let me just start with a question. When MTN came into the market in 2019 to now is 4.5 years. Let's say 5 years. Okay, 5 years. 5 years. We're in February now. 5 years, maybe 2 months. I know it was mid-2019, so it was not like January 2019. So let's say 5 years, actually. They listed in the market at, I think, 19 naira. Yeah, 19 naira. 5 years ago. Who can tell me how much it is today, maybe last Friday, the last time you check, I'm sure it's already above 250, right?
Yes.
70, like 255.
2 what? About
270. I saw 255 on Friday.
Yeah, but at least above 250. Good. I don't know what is the percentage change. If you want to just quickly do one, 90, let's say 255 percentage change. I just did the percentage change on this calculator. It's 183, about 183%. Remember, we are talking of after, in other words, 283, because the 90% is the base, that is the 100% base. So if you look at it, 90 plus 90 is 180, plus another 90 is 270. So you're actually looking at close to 290%. You have, if you multiply 90 by 3, you are talking of 270. And I know it touched 270 briefly. And because of the recent government policy giving them permission to increase their data cost by about 50%, we expect that the revenue will likely go up, and that has pushed some attraction towards the stock. If you check since that announcement and since they started implementing it, the buy signal has been very, very strong. So you want to now imagine those who enter the market and understand the way the stock exchange market works at 90. Maybe you had the privilege of investing 90 million in 4 years, 4.5 years. And by the way, this 2 something was even a drop. There was time it crossed 300. You know, you have the privilege of taking out of the market what you invested at 90 million. You are coming out at close to 300 million. I mean, who can beat that? That is how. That is the potential that you see when you understand the market. Now, there is a crying baby in the market, but that has also given so much money to people who are a bit on the high side when it comes to risk, have a high risk appetite. Oando. For a very long time, Oando was trading in the neighborhood of 9 naira, 7 naira, 9 naira. That was just sometime, early 2024, late 2023. And before you know it, Oando acquired 40% stake in Ajib. Yeah, he acquired the portion of Ajib offshore business. And they also bidded for some other offshore assets, some of the IOCs, including the last one they are just bidding in Angola. Because of those settlements, and including the fact that people have the feeling that the current government is has positive sentiment towards them because of the son of Tinubu and all whatnot, the stock grew from that barely early 2 digits, average of 10, to close to 70 naira, and even went close to 90 before moderated close to 70 naira. And why I call it crying baby is because for so many years they've had accumulated losses. They've been sanctioned severally by the Nigerian regulators for not, publishing the compulsory mandatory statutory reports. Once in a while they go under suspension. Even the Johannesburg Stock Exchange, where they are also listed, at one time suspended the stock because they failed to meet the deadline for listing of regulatory returns and all whatnot. So they've been back and forth, trying to build on their corporate governance structure. So for many people that are into the stock exchange, they've had, various view about Oando. But I went into Oando. I went in when it was already about 20-something naira. And I know with the current price now, that is already more than double. Okay. And just very recently, they decided, because they've not paid dividend for a very long time, to give 1 share for every 12. So it's form of like a bonus script dividend, trying to redistribute some, shares to investors. Again, look at the trends, the type of, capital appreciation that has happened just within about 18 months, 2 years. If you have a 10 million and you are getting close to 70 million, the percentage change, you can do the math. Now, I talked about shocks and surprises and, some external events that might have direct implication on the market. Look at COVID periods. I will use First Bank and Zenith. All this talking about giving some of these demonstrations and experiences is just to tell you the potential in the market. And the good news is that these variations will continue to exist. And because they continue to exist, the potential for making money will always be there. So there's nothing like, oh, I didn't enter then, I cannot enter now. No. If you enter now, you can still make money. And I will tell you, before we conclude, some of the sectors that most analysts are looking at. When COVID came, there was just this, upheavals, labalu, fears. People even thought the world was coming to an end. We're not sure because a lot of people have never heard of, I've never experienced such before. And it was as if everything was going to shut down. So there was panic. Zenith, for instance, fell to 9.60 kobo. Anybody can quickly just do a quick check. 9.60 kobo. And by the way, there's an app that gives you everyday price for the past 5-10 years. You can check back on. There was a particular time it dropped to 9.60 kobo. So, but COVID was 2020, right? 2020. That's about 4 or 5 years ago or so. Today, just a couple of months ago, Zenith came out to the market to raise capital pursuant to the recapitalization policy of CBN. And they raised capital in the market for those that are already existing shareholder. Right issue was 36 naira, and the public offer was 36 naira 50 kobo. Let's even assume that you bought that 36 naira 50 kobo. That was barely 6 months ago. It's not up to a year, barely 6 months ago. 36 naira 50 kobo. As at Friday, I can quickly give you, as at Friday, the Zenith stock, I'm sure most of you will know it. You can just download investing.com. There are many apps, but one that is very handy and it's also free subscription. You have a premium subscription that can give you more functionalities, but you can also download that, investing.com. Zenith Bank was 51.6, which is about 52 naira, right? Good. 51.6, which is about 52 naira. Now, just imagine just 6 months ago when you heard it in the market, everybody is trying to raise capital to meet up this capitalization policy of CBN. You came in at 36 naira and you are now on 52 naira. That is a massive close to 16 naira. 16 naira divided by 36, 16 divided by 36, that's already 44% within a period of barely 6 months. 44%. The Nigerian inflation rate is 34%, so you beat inflation. And inflation is a measure that is per annum, the CPI. So if you use 6 months to do 44% on an annualized basis, that is actually like close to 80-something%. Because you can actually take out 44% and reinvest and make additional money. So you are actually, doing better and you can beat inflation no matter what. And that is just one example. That is 6 months ago. But for those who understand stock exchange market and went in when COVID brought the price to 9.60 kobo, you can imagine those who got in 9.60 kobo, let's say 10 naira for ease of calculation. And now it is 52. So if you were lucky to put in like 100 million, then you are 520 million, worthy now. So you see how the potential of the stock market can make someone to be a billionaire. So when I was sharing with my colleague, the apartment, actually, it was a land it was referring to when I mentioned Metama. Where I stay is in Naval, in Sokoro, where I bought a property. I bought 3, within that Sokoro. I was just sharing with them how I sold off Dangote shares. I got into Dangote when it was barely 38 naira. And of course, many of you know that Dangote cement actually got to 600. On Friday, it is now 480. So you can imagine when we went in about 5 years ago at 38, and let's even assume it's just 38 million. Let's even assume it's just 38 million that you put in 1 million shares at 38 million. So 480, that is 480 million. You know, so I was just sharing how I was privileged to be lucky with, you know, Dangote, and I saw a property that was selling at a price that ordinarily, based on my, you know, salary, I will not be able to even go close. In fact, where I stay, based on my salary, I can't pay rent. I can't be a tenant in the location. I can't be a tenant because my BQ of just 2 bedroom is actually 6 million rent that I gave it out. The duplex in F is about 45 million, 50 million per annum. So it's not a place where I, as an individual, can pay rent. Even if I were to combine my annual salary and I decide that, okay, I don't have any expenses, I will not be able to pay rent there. If I pay rent there, it's like using the whole of your annual salary, maybe with little change, even, or maybe the whole of the annual salary. You pay rent and you now be thinking of, oh, how do you pay other bills and all that? So it's not like a practicable place for somebody like me to pay rent. So I was there. So we're just sharing how the stock market can elevate you to a place where ordinarily you cannot belong, but because of the, you know, stock market, you can do that. I just gave you, you know, some examples of some of the stocks. Many of you may remember, for those of you that have been in the market, this cement company, CCNN, is a cement company of northern Nigeria. If you remember very well, they sold themselves to BOA. When BOA was coming out to compete with Dangote a couple of years ago, one of the cement companies they bought as part of the merger was CCNN. CCNN came out, was in the market for a very long time because they were not really among the major competitors. They were running around 4 naira, 5 naira at the time. When there was a background rumor that there may likely be a merger, it was getting closer and closer to 11 naira. But guess what? What was the price that the minority shareholder of CCNN demanded from BOA for them to sell off the company to BOA? 44 naira. 44 naira. So whether you entered when it was barely 4, 5 naira, you will be paid 44 naira. Whether you enter when it was 11 naira, when they wanted to delist and be you know, absorbed by BOA, the shareholders demanded for 44 naira. So it was 44 naira we got. Some of us entered when it was about 7 naira or thereabout. But when it was time to buy us off, they bought us at 44 naira. This happened at early 2021. 2021. Yeah, 2021. That was when it happened. I remember because it was a significant event in my life then. I lost my dad that year. So early that part of the year, I knew I sold off. Is it 2020 or 2021? Sometime around close to when my dad was very sick and eventually passed. So you can imagine those who even bought when it was 11 naira was when the news came out that they wanted to merge. So they want technical suspension. So it was just there. So it was not a case whether you lose money or you gain money. Even if it was 11 naira and it was technically suspended, when they concluded all the discussion about merger and all whatnot, everybody that were holding it at 11 naira got 44. So that was clearly four times. 4 times. So if you have invested 50 million, you are talking of over 200 and something million. So there are people who understand the market. So what I do as an individual before I go into other specific is, because the market has its own risk. Of course, every investment has their own risk. You want to diversify. So that is part of the reason why once I make massive return, there are some stock that have given me 800%. I will not be able to share my stock account, but you can, if I like, I can just show you the cost column and later show you the the market value column. So that gives you an idea without necessarily show you the amount that is in there. There are some that are 1,000%. There are some that are 800%. There are some that are 700%. Of course, there are some that are losses, but losses are few. I can show you that the losses are very, very, very few. You know, so what we do is when you make massive return from stock and you are also serving the real estate, you look for a good location because real estate is driven by location. So you look for a good location and you go in. I'll give you them an example of, if you know Abuja, you can quickly find out that's where they call Admiralty. Admiralty Estate, popularly known as Navy Town, is also in Asokoro. You have Navy there, you have Army. So Navy started, Army, the Nigerian Army brought out their estates. So the duplex, they were giving it out for military price of 105 or thereabouts. 105. As of January 2024, it was still 105. So I convinced my elder sister, my friend, and myself. So we bought into that place, 105. I sold off some stock and I bought. My sister that is based in UK, brought in some pounds. We helped her to change. We bought sometime around late January, February. By June, the military brought out a revised price for those same property that we bought at 105. They brought it out for 360 for those who want to take advantage of the 12-month installment, and 300 for those who want to pay outright. So within a period of 6 months, by moving some value from the stock exchange to property, we haven't gained in the stock exchange. By moving it into the real estate, we still, if you buy something at 100, and you sell it at 360, that is times 3, within a year. But then those kind of good locations are not where you sell, because those were even privileged buys. The real value of property around Asokoro, you see 1 billion. If you see something close to 700, is because it's still very fresh area that doesn't have infrastructure and all. So that is how you can move from, real estate to, from stock market to real estate. This is what I'm trying to share with you guys. I don't know, it's not possible to view it. Maybe, I don't know how I'm positioning my hand, but whatever, the price is here, the things are here. Okay, so you already have an idea of what we are talking about in terms of the capacity of the market to give you, what you want. In the market, there are 3 boards. We have the main board. These are for well-established companies like Zenith Bank, Dangote, those top companies, Nestle, and all that. But I will not fail to, let me come to how you pick stock before, how you identify value stock and growth stock before I go into other examples. Now, if you are a beginner or you are in the market, but you are wondering why you have not been, making so much money, maybe we'll just run together through some thoughts that if you have not paid attention to it, you need to, if you are paid attention to it, you need to convince yourself that that is the right step to go. Now, the first thing to do is to look at a couple of factors about a company that is under review, because you need to be able to have a universe of, or a cluster of companies that are under consideration. And what are the filter criteria that you use to select, those stock? The first is the type of product and services. What are the product and services that those companies are engaging? What is their elasticity to demand? Are they products or services that have very strong close substitutes? Are they products and services that, in a short while, they might no longer be useful to mankind. They might not be useful to people. Maybe there will be massive alternative and those products will go into extinction. So you want to look at products and services that is being rendered. Take a product like palm oil. Palm oil. I want you, after this session, to go sit down and look at what the two dominant players in the palm oil sector, Okomu and Presco, what their prices were 5 years ago and what their prices is now. I know the last time I checked, Presco was already about 600 or thereabout or more. But these were stocks that were 38, 40, 50 naira, right? Even when they got to 90, 100, people were wondering, oh, really? Komu with low float, you want to sell, you need to sell it in bid. What's going on? Why is driving the price? But I knew that the product palm oil has multiple uses. We are not meeting Nigerian markets. What further convinced analysts was when the Ukraine war started, Presco is now over 700. I just checked investing.com, is about 784 naira. Now, when the Ukraine war started and Ukraine, Russia war, when they started, Ukraine was, supplying so many type of oil to the world, grains. They were market leader when it comes to, global leader when it comes to some of those products. And then they stopped supplying to many countries. We knew that Nigerian palm oil was going to explode. And before you knew it, Presco announced investment. They bought into some palm plantation in Ghana, some West African coast, and they were trying to expand their capacity. Okumu used to be bigger, by the way, in terms of land size, in terms of investment. Okumu was far ahead of Presco. But Presco was more agile, more nimble, more strategic. They have some strategic acquisitions, strategic investments. They have dynamic leaders. So you want to look at how they were, the story of how they succeeded is there for everybody to look at. Today, they are approaching 1,000. I can bet you they will hit 1,000. Now, I was talking about product and services. You want to think, you grew up, you met palm oil. No matter all this olive oil, coconut oil, vegetable oil, castor oil, name them, sesame oil. I'm sorry, I don't know all the oil, but I mentioned some very common one. Palm oil continue to play a dominant role because the people that use olive oil and castor oil, maybe those kind of special oil for hair treatment and whatever, are among the bourgeois, the few people. Because of, cholesterol issue, health issue, trying to say, okay, I want to live a little big, I use olive oil, right? I use more of olive oil, sunflower. But even in my house, despite the fact I use olive oil and sunflower, we have Okomo oil, we have Presco, red oil for short is there. Because of course, olive oil and sunflowers are very expensive. So you must use red oil. And that red oil, children that are growing up, whatever, they can use red oil. So in the red palm oil can be used for soap, cream, different type of sub-products. So you know that the substitute for palm oil is not much. That's one. Into the long future, into the foreseeable future, the use of palm oil will continue to exist. So it is not a product you will be wondering, why should I invest in that kind of sector? For those people that have long-term view, and by the way, as part of an investor, you need to have stock that you have for short-term, stock that you have for medium-term, stock that you have for long-term. So one of the stock you can invest into the long haul is a product like palm oil. You invest in Okomu, no matter the price, you know it can only continue to go up. So that is what you check, product and services. But take, for instance, Unilever. Unilever price has been atrophied, even though sometimes you see some spike, but have been generally vitiated by the fact that some of the products they are into, like soap, liquid soap, and all whatnot. Many of you in this platform, maybe if we take a census, close to 10, 20, or even 30% may be already doing their own liquid soap in their houses. Not because you cannot afford the one in the high-profile shops, but because you have found the technology, you have all the various chemicals you bring together, and you make your liquid soap. I personally cannot remember the last time we bought, liquid soap from H-Medis or whatever you name the various FSC, fast-moving consumer goods shops. We make those things by ourselves. Maybe because the bar soap, you must make the one you use, you must buy. Otherwise, even the one you use to wash soap, wash plate and all that, some people, you make all those things by yourself. So because of close substitutes, the masses, the bigger number of people in Nigeria, the larger number of people in Nigeria are able to find an alternative to liquid soap. The performance of Unilever have been struggling for a very long time. There was a time Unilever price, very long time ago, over 100. But now when they get to 30-something, people that are invested in it are happy, right? So because of close substitutes, because inability of their products to have a differentiation, a competitive edge in the market and create a niche, then because the people that can buy those specialized soap now are people that are wealthy, and the wealthy people are the minority in Nigeria. The bulk of the market can make their own soap. So their products have close substitutes. So it's not a stock you want to hold for a very long time. It's a stock you want to take advantage of the various price movements. Sometimes it goes down with about 20, 30%. You come in, when it rises, you take out. But when you want to put into a long haul, you are worried because of the possibility of substitute. But Tokomu, for instance, I just give you an example. The substitute is very, very, very low. When you look at that factor, the product and services, you want to equally look at the governance structure of that company, corporate governance, how a company is directed, the board, the tone in terms of, risk management, the tone in terms of board structure, diversification, gender equity, share ownership, various factors that are implicated when you talk about corporate governance. If you have a company where there is an overriding one man as the alpha and omega, you want to play short. You want to play short because even though the company is very profitable, even though the company is very robust, you are concerned about the board structure, you are concerned about a key man risk and all that. Now, till today, Dangote is the richest man. He have Dangote cement, he have Dangote sugar, he have a huge percentage, practically the owner of NASCON. Of course, he have Dangote rice, which was about to be listed. I will come to some of the issues that happened where people made so much money. I also burned their fingers when it came to the Dangote ecosystem. But you see, for such a company, the advantage is in the dividends. Because it is an owner-managed enterprise, and go and check the BIOS, almost all the owner-managed enterprise, they pay fantastic dividends. They have fantastic dividend yields. Dangote Cement is one of them. It pays a huge portion of the earnings as dividend. The payout is very robust. Very long time ago, Dangote was already paying above 11 naira per share as dividends. And recently, they paid over 20-something naira. So that is because the owner uses dividends to pay themselves back. They have the bulk of the percentage of shareholdings, and because they want to package themselves as being a bit more, well organized, they don't want to be seen to be dipping hands, although they make money from different ways, maybe through expenses and all whatnot. But when it comes to corporate income, like dividends, they must give themselves huge dividends. So if you check almost all the owner-managed companies, you get good dividends. Zenith Bank is one of them. Zenith Bank dividends for the past 8 years, 10 years continue to grow. And this year is projected to pay above 5 naira. Last year, they paid 454 naira 50 kobo per share. So if you look at those, I even bought shares at 36 naira. If you get 5 naira, that's already above 10%. If it was 3 naira 60 kobo dividend, that would be 10%. If it is 4 naira dividend over 336, that is slightly above 10. If it is 5 naira, of course, it's also above 10. So they pay good dividends, because most of those companies that are owned where the board is dominated by a key man, they must pay themselves back with dividends. Those that are owned by, where the owner is really the dominant player, you want to be playing them, short. You don't want to go in a very long, long haul because of the risk. But I just gave that as an example, but the like of Dangote, whether it's a key man or not, it's a highly diversified company. If Dangote were to die today, the risk of a key man will not materialize. Will not materialize because the products that they are into, which is cement, the market and distribution lists that they have, the brand and the goodwill will always be bought over by the nearest competitor. So it's not a company that when the owner dies, the company will die. So even though in theory, we hear story like key man risk, a time will come where the risk of a key man is underwhelmed, is far less compared to the value proposition that is already in the market. How do you imagine when you talk about customer lists in itself is an asset. Talk about goodwill, talk about brand, talk about market spread, talk about distribution, talk about investment, capital, both capital and all are otherwise invested. These are not something that will die when a key man dies, because the product will continue. The worst that will happen is an investor who is also, a competitor is also in that space. We want to ride. Imagine someone we ignore. If Dangote was to be on sale as a company, imagine a Lafarge, we ignore buying it and choose to establish their own cement factory, get new set of distributor, get new set of market. You imagine that it will be easier to just do plug and play. So if you went, even if you have the billions to invest in new cement factory, you just want to pick and plug and continue to run with the distributors and others. So there are some structure. The owner might be dominant in terms of the board structure, in terms of share ownership, but that does not mean that when they die, the company will go. The same with some of the big banks like Zenith Bank. UBA is dominated by Elumelu and all its investment around and all whatnot. Whether it dies or not, you will see the companies grow. So you have an advantage for a company that is owned and managed. That's what we call owner managed. In other words, the management is influenced seriously by the owner. They pay good dividends. If you go and check, UBA dividend, it is very good. Zenith Bank dividend is very good. Dangote dividend is very good. And because they are owner managed, most of those stocks continue to show strength because the owner wants to have capital appreciation. So even when they die, there may just be a small shake, then they will bounce back and everybody is happy. So filter criteria number 2, we have talked about product, talking about governance. The next thing you want to talk about is the market leadership. In every sector, we have market leaders. When a market crashes, the last to go down is the market leader. And when they are recovery, the first to come up is the market leader. So in any sector you want to invest, as part of the filter criteria, and you are trying to select stock, you have looked at the product as part of, you have passed it through the eye of the needle, one of which is the products and services, how inelastic it is, flow substitute, and all the various variables we talked about when we were talking about products and services. Look at the governance structure with emphasis on the board and the share ownership. Then you want to also look at leadership in that sector. If you go to the cement sector, for instance, you have the likes of Dangote Cement, you have Waco, Lafarge, you have Bois, there are a few coming up that are yet not listed. The Sokoto Cement is there. I mentioned how CCNN, gave themselves up. Then maybe you have some few small factory here and there. But in the bars, these dominant players are there. Dangote, Bois, Northern Cement, NNFFM. No, NNFFM is there, but it's not really. I think it started growing recently to about 18 naira. Then you have BUA, which got to 183 and is now just barely. In fact, BUA is selling at its 52 weeks low at about 83. So anybody that even buy BUA now, even though the price is in quote high 83, has value because it is a stock of close to 200. And I will tell you why. So you talk about market leadership. There are some sectors where it is difficult to have a clear-cut leader. The cement sector is almost an oligopoly, very strong, competition. For a very long time, Dangote was a clear leader. Before you know it, BUA came in. When Dangote announced that they're going to crash price, Dangote ignored it. And I mean, that is a typical feature of an oligopoly. And because he ignored it, the price cuts did not make any movement in the market. Rather, if you don't go up, you lose. Because they were trying to be political, government were looking at how do we crash prices. So they were the first to come out to say we're going to crash prices. But how do you crash prices? Nobody followed. Dangote did not crash their own. Lafarge did not crash their own. Before you know what's happening, the market continues as business as usual. You go to the various shops, even when BUA has announced that they crash their prices to 4,000, 5,000, or whatever. If you want to go and buy, you see buy is almost similar because the person that is selling Dangote cement is the same person that is selling BUA. If you go to his own shop, even if he has the BUA, he will tell you he doesn't have. He wants you to buy the expensive one so that he can sell. It's even the buyers that will say, give me any one you have because they need to collect and they're ready to pay. So that price movement did not make any meaning because the competition is so steep that it's basically like an oligopoly. It's not a perfect competition. And so you need to be able to understand the way the market is. So it's hard to have a clear leader, but in that sector, Dangote still came out top as the clear leader. So if you have an opportunity to invest, you want to ensure that I want to invest in the cement sector. Among the various companies in that sector, I want to have Dangote, I want to have BUA, I want to have Lafarge in quantity that your capital can take. For me, the one that have strong value right now is BUA because of the price. It's really very good. I got into Lafarge at about 20. Lafarge is over 70 now. I know I've made so much money in Lafarge, and that is because it's a bit more well diversified, French-owned. They have problems because of FS challenges, and that is even an opportunity because they will always come out of those challenges and the opportunity will continue to go. But when you hear the Minister of Work and Housing, Umai, saying that they want to award several roads running into billions and multiple billions of naira, and they want those roads to be concrete, they want those roads to be cement, use of concrete, mixture, and whatnot. What that tells you is that for a few years, at least for the few jobs that have been awarded by the ministry that are already cash back in the budget, a bulk of some of those construction will be driven by cement and mortar. And we're not going to be investing, and we're not going to be importing, this cement. It is the market players that will be supplying, those cements. And what that tells you is that they're going to increase their revenue. So revenue will grow in the cement sector. That one is dole. And whether it grows now or not, it's just a matter of time it will grow. Cement is also another product. Even though there are alternative technology, it will not be a dominant technology that will push out cement in a short while. There are so many synthetic way of building houses. During the COVID, we heard of China building a big hospital within a couple of weeks or months, whatever, because it's just bespoke from the chef. They just brought all the various compartments, layer it together. There was a property and all the facility was set. Yes, it's possible those kinds of technologies exist. They are very expensive compared to cement. Cement will continue to, play a dominant factor in the construction sector into the very long future. So even if anybody in this platform is just 10 years old and you are wondering, oh, if I invest in cement, how am I sure in the next couple of years somebody will not bring a technology that will push out cement? I can assure you, no. You will grow older than us. You will grow into the future. Cement will still be there. So the market for cement is, even when you call it precast or whatever, some of the byproducts and what they are using, the raw material, is still cement. So that's another sector. So you talk about market leadership. You go there. In the banking sector, you want to concentrate on the fugas. Zenith Bank comes up in terms of the very, very capitalized UBA, GT Bank, you know, and even the mid-tier, you have people like Stanbic who are very, very dominant in asset management. They're making so much money in asset management, but because of their low float, their prices is always above 16 naira, 17 naira. They can hit 100 naira, but a bit slow because of, you know, they have very low float in the market. When I talk about float, is the number of shares that are in issue and your ability to buy and sell easily. So because of that, investors sometimes want to buy Zenith, want to buy GT Bank. GT Bank, because of their return on equity, come a little better in terms of attraction to investor because their price is more volatile and give room for people to make money. I think right now, in terms of, apart from Stanbic, they are the highest, over 60 naira in the market. They're followed by Zenith of over 52 naira. Now, First Bank, when they were having this boardroom tussle with $10 and all those challenges and all that, they were just crawling above 20, 21 naira. Some people were afraid and say that, oh, maybe regulator will sanction them and all whatnot. First Bank is a systematically important bank, SIP, and they've gone through over 100 years. A long time ago, we heard First Bank is already over 100 years, so it's more than a century, right? But because of poor corporate governance, mismanagement, and that massive 90 billion debt from the about 2 decades and all that, they had challenges, particularly those debt that was used for Dangote, honey flour. So when they wrote off those debts, they crashed badly. To the extent that during COVID, they were as low as 3 naira 60 kobo, but I know they are above 30 something naira now, which is close to times 10, all right? And if you check, when they were having those boardroom tussle, smart investors went in because they knew that those boardroom tussle was very temporary. It's not a tussle that will make 100-year-old company to say they are not existing, and it's not even possible because they are systemically important bank. We understand the relationship they have with the regulator. There are some banks the regulator will never allow to go down because they have high systemic importance to the economy. If First Bank go down, a lot of banks will go with it. A lot of institutions will go with it. Zenith Bank the same. Why? There are many locations across the country today where central bank uses some of these banks as clearing bank because they don't have central bank offices in those locations. So they depend on some of these systematically important banks. Apart from the fact that if the biggest bank, if they start going down, investors will panic and it will have serious implications on the economy. So there is many reasons why it's going to be difficult for it to just go down just like that. So people went in at 21 naira. This tussle was just a couple of months ago. And people are smiling back to the bank now with 30-something naira. So you want to look at a sector who are the market leader. You want to go in. If they are crashing, the more a market leader crash, the better the opportunity to buy. The more a market leader crash, the better opportunity. That's why you hear the popular, Mazim saying, buy when there is blood in the streets. You buy more shares when there is blood in the streets, but not any share. You buy market leaders, you buy those that are well diversified, you buy those that have products that are relatively inelastic, you buy products that have boards that are well diversified, that have good corporate governance, and all whatnot. I just mentioned some of those few, filter criteria. Take a look at Nestle, for instance. Coming to global companies that have institutional investors that control the equity. Nestle is one of those companies that pay out close to 80-90% of their earnings as dividends. The reason is the institutional investors are outside the country. They have massive investment in Nigeria. So whenever they declare earnings, they pay a bulk of it out as part of payouts to those institutional investors. So these are stock we call income stock. Their growth potential is not strong. You can hardly do double in those kind of stock, but you will always make money every year because they will pay you good dividends. So when you mistakenly see any of such stock crash by 40-50%, you know it's a buying opportunity. When sometime last year, because of FS challenges, most of these big companies that have importation element in their operation were suffering because as at the time they took money from banks as a credit, dollar during Emefiele was 440 something. Many of you will remember, despite the problem we were having during Buhari, Emefiele was able to keep the official rate at 400 and something, whereas the black market rate was about 800. So there was serious spread, arbitrage opportunity. But at least official rates that determine bank transaction that you use for letters of credit was 440 something. Many of you can remember. Just before Emefiele tenure. This is less than 2 years, 1 year. These international organizations and big companies that have to import their materials, that have import elements in their operations, they opened letters of credit at 400 and something. Then Tinubu came in. Tinubu came in, the CBN brought out so many policies and they liberalized, they removed the hold because Emefiele was basically using our reserve to defend the Naira, trying to keep it within that 400 and something for as long as possible. Whether it was sustainable, whether it's a good policy in the era, there was implication. As soon as that ceiling was removed, the official rate and the black market rate was almost converging. So you see official rate climbing from 1,000 to 1,400 to 1,500, even got to 1,600 before it started moderating. Today, while black market is about 1,610, 640, the official rate is about 1,500, ranging between 1,500, 1,540, and so the difference is just about 100 naira. So what is the implication? Someone that engaged in an obligation when dollar was 400 and something, and the obligations are maturing, you need to pay on those obligations. And then we are in Nigeria. The product you are selling, your account balances are in Naira. When you buy cartons of Milo, Nestle product, you credit their account in Naira. But when they open dollar 440. They now need to buy dollar. And they went to CBN. CBN is saying dollar is now one massive difference of close to 1,000 naira. Who bears it? The company will need to write it off. So you now had a situation where for the first time in the history of Nigerian BIOS, a Nestle as a big company had negative capital because they wrote off, they took the loss, and their capital became negative. And the implication was people dumped the shares. So a stock that is basically like 1,500, 1,600 on the average, 1,400, 100. People who knows about investment knew that has nothing to do with revenue capacity. That loss and negative capital had nothing to do with loss of market share. That had nothing to do with whether people were not eating Milo, chocolate, and Milo and not Bonvita or whatever. It was just a technical loss. So smart investors mop up because this is a dividend stock, not a growth stock. It normally is above 1,000. What happened? Why did it drop to 700? People were afraid. Negative capital. Smart investors knew bottom line is different from top line. When a company who have growing top line, but the bottom line is negative, it's an opportunity for you to know that that company is selling below its market capacity you buy. So people bought. And now, lo and behold, they've crossed the 900, they touched 1,000 basically, they went back and settled about 990, 990 something. They are going back again to their regular 1,400 because they are gradually writing off and paying back the massive loss that they took because of the FS exchange. So they are the market leader by far. You don't compare them with Cadbury, which is their closest competitor in the market. So in a sector, you are looking at market leadership. You have a Cadbury that is selling, that dropped to 19 and it's now coming back to 20 something. Then you have a Nestle who is dominant for over 1,000 by far, and you saw it at 600, 700, you don't want to worry yourself, because like I mentioned, when the market, a sector is crashing, the last to go down is the market leader. When they are recovering, the first to recover is the market leader. So Nestle, even though it was not a growth stock, even though it was just basically a dividend stock or an income stock, when you see such market leaders that are non-growth stock halving their price because of technical challenges, it means there is blood in the street in their own environment. You quickly mop up. So this discussion has touched on so many factors that you consider for those of you that are already in the market, and for those of you that are contemplating going in, the nuances around stock. You cannot go deeper without understanding the various filter criteria on how to pick value, high growth stock. The topic today is how to pick, high growth stock. When you pick each of these stock, you want to also look at another factor like government pronouncement and regulation. Now, there's a stock in the market, Jais Bank. It's one of the non-interest bank. When Jais came into the market, it was 0.5. That is 50 kobo. Who can tell me what Jais now is? It's a sector that the banking sector is dominated by 3 naira something, right? That's fine. Yeah, you can always get that from, you can get that 3 naira 60 kobo actually. It was 3 naira 60 kobo on Friday, Jais. If you are looking at that investing.com, you will see a particular line they call 52-week range. If anybody have that 52-week range, it shows you what the price was in terms of the lowest within a year and what it is the highest within that same year. 52 weeks range, a year is 52 weeks. If you check Jais, even though they were in the market for long at 50 kobo, their 52-week low within the same 1 year that we are in was as low as 1 naira 90 kobo. 1 naira 90 kobo, right? 52 weeks low. Yeah, I can see somebody chatting. 52, 1 naira 50 kobo within the same year. And on Friday, it was 3 naira 60 kobo. Now, let's assume you were not even available when it was 50 kobo. You didn't know when it was 50 kobo. You didn't know when it was 90 kobo. You didn't know when it was 1 naira and all that. We're talking of just within a year, 1 naira 90 kobo to 3 naira 60 kobo. When it is 3 naira 80 kobo, that is times 2, because 2 times 1.9 is 3 naira 80 kobo. So this is Jais Bank. This is just Jais Bank now, So there are some penny stock, because I'm gradually getting to picking. I'll be mentioning how to pick high growth, high value stock that are market leaders, mentioning Zenith, UBA, various sectors, Dangote. These are big companies. The price in the market, maybe for some people that are having small capital, they may look at the price are very high. How do you buy a stock? 1,000, 900, and you have just maybe 1 million. You want to get more. So if you look at some penny stock, within a year, 1 naira 90 kobo to 3 naira 60 kobo, like times 2. So even if you was 19 million, you put in there, and I get it 38 within a year. I mean, your expenditure will not be like, and after that 38, and you are the type that like to build a portfolio, you can take out 30 and put in government bond. Government bond was 19 naira, between 19 to 20%. 20% of 30 million is another 6 million within a year. So you use the stock exchange to make close to 50%, 100%. You now put some of them in the Nigeria fixed income market. You make another close to 20%. Before you know it, that 19 million that became 38 plus another 6, 7 million is now 40 something. You look for a small property that is a distress you bought, and in 2 years' time, because of the location, it's 19 naira. So you start with 19, you are getting close to 90 million, you get into, so we're talking of wealth creation. According to wealth creation, it's simple, it's formula, it's determinable, it's straightforward, it's something that you can tick off, it's something you can understand. It's not like It's not magic, you know. And when you are inside this same, when you are inside this arena, the atmosphere of wealth creation using various instruments, even if you are a government officer and somebody is trying to analyze how you can use one invoice to steal or whatever, you will not be interested, because the kind of money you are making, first of all, you understand how to double your money using the Rule 72. I'll give you an example. In that was 2020, right? Yes, 2020 was the first time after a very long time that the Nigerian government floated the Sukuk bond. For a long while, it was mainly the normal, regular, government bond. So it had to float a Sukuk bond because people were beginning to demand halal compliant instruments that are Sharia compliant, money that are not going to be used for, speculation, not to be used for, drug, alcohol, not to be used to fund anything that is unethical and whatnot, just basically for infrastructure development and all whatnot. So they floated a Sukuk. As at that time, they came out at 11 naira 20 kobo, 11.2%, yeah, just barely above, slightly above 11%. So you do the math, you say, okay, 72 divided by 11, close to 5 years, 5 plus, okay, let's say 6 years, not exactly 6 years, but close to 6 years, that you double your funds. Then before you know it, instrument grew as high as 20%. Just almost all the instrument that has been issued by government in the last 7 months, almost every month they'll be raising capital. Almost every month they'll be raising capital. Even the secondary market, if you check the federal government bond, the secondary market, many of them are pricing at a discount. You see some of them at 96 kobo. The face value of every bond is 100 naira. But when you see it at a discount, you will now see 96, you see 70-something%. And so that increases the yield. That increases the yield. So you see a lot of the bond. The Nigerian federal government bond, April 2029, in the secondary market today is 19.3%, right? 19.3%. So if you go by that 19.3%, it will take you how many years to double your money? 72 divided by 19.3. So with about 3.5 years, 3.7 months, your money will double. So now you made money in stock exchange. You made money in stock exchange, you take out your profit, you left your principal to continue to run. You put it in Nigerian federal government bond, April 2029. That is in the market as we speak. If you want to buy it in secondary market, you can get it, 19.3. And maybe it is just 10 million you have. I like using 100 million as calculation. But let's say for ease of calculation, you have 10 million. In 3.5 years, that 10 million will be 20 million. It could be more. It could be more because for 100 million, what it means that for 100 million, every year they give you 19.3 million. They give you 19.3 million free. There's no discussion. You are not doing any analysis. You are not doing filter criteria. You are not doing all this analysis we are talking about now. So you get 19.3, and in 3.5 years, it will get to 200 million. But what do you do with that 19.3? That 19.3, when they give it to you, you either reinvest it in the fixed income to get compound interest, or you look for growth stock and put it, because stock is the highest return. Stock can give you 100, 200, 300% easily. I just mentioned Jai's Bank, 52 weeks, 1.9 to 3.6, about 90% easily within a year, 90. Most of the stocks I pick, 70%, 80%, 90% easily. But why you still need portfolio is because in the equity market, your capital is high risk. You need to know the one you trade. Like Nestle, low risk. You have some few ones you can trade, and the one you can keep for long. You only lose in the stock exchange when you sell at a loss. If you have picked the stock, subjecting it to the filter criteria we mentioned just a couple of minutes ago, if you have picked the stock, subjecting them to the filter criteria we mentioned just a few minutes ago, ticking off boxes like the type of product and services. What are the inelasticity? What are the substitute, close substitute, governance structure, market leadership, and all the bottom line fundamental 5 years annual report and all whatnot, dividend history. If you subject them to those filter criteria and you pick them, you cannot lose. Almost you cannot lose. You will only lose if you sell it at a loss. What you do when good stock that you have selected are crashing, provided you pick them and you pick the market leaders, you pick well-diversified companies, you pick companies that are having product that don't have close substitute, companies that have product that will be there for the long haul to our children. So long as you have picked those stock, whenever they crash, what you're supposed to do is to buy more at the low price. That's what you hear people saying, buy the dip. Buy the dip. Buy the dip. That is what they mean by buy the dip. Just imagine Nestle, like I mentioned, you check 5 years, average 1,000, you look at the technical curve. Those are high-level discussion, like I mentioned, the mark, the 30-day, average price and all whatnot, buy signals. Those are not things we discuss here. But you know that it's a value stock that is high, that is well diversified. The product are ranged, very well diversified product, very well diversified board, global player, children will always be born. They have products that are going to be there for a long haul. You now see it at 600, 700, you buy. You buy the dip at that point. What you do with buying the dip is to average down your weighted costs. For instance, you entered Nestle now. Nestle is 900 and something naira now. Let's say 900 for ease of calculation. And suddenly you see Nestle at 700. An investor that is not very savvy, that is a bit inexperienced, will panic. I bought something at 900. It's now 700. I am suspecting it may go down to 500. Let me cut my loss. You hear people say, let me cut my loss and let me go out of this stock. Wrong. It was a good stock. It was subjected to specific filter criteria that analysts agree upon. When you buy 700, this is what you do. I bought 1 million units at 900 million. And I bought another 1 million units at 700 million. 2 million units is now 1.6. Divide by 2. The average cost has dropped from the initial 900 to 800. So many of you are inside stock market. You possibly must have bought some stock when it was 10 naira. Those stocks are now 2 naira, 3 naira, particularly under those insurance companies. Most of you that bought insurance those days are 3 naira, 4 naira, it now dropped to 50 kobo, 30 kobo. So you started panicking. What do you do? Some of you took your losses. But if it's a company that have been properly selected, what you bought at 10 naira is now 50 kobo. What you will need to do is go and calculate the quantity you need to buy at 50 kobo. So that by the time you do the average, your total average cost may be even 60 kobo. Sunu was one of such. Early last year, you can go and check, Sunu Insurance was still running around 30 kobo, right? Who knows how much Sunu got to 2 months ago before he moderated down? Sunu.
10 naira.
Yeah, we crossed 11 naira. We were able to keep, we crossed 11 naira. Yeah. Sunu crossed 11 naira easily. It was the best performing stock in the market this couple of months ago. As an insurance stock, what was driving the insurance sector? And that is why we're talking about government regulator policies and all that. As soon as banking sector capitalization, finish, the NICOM, the regulator for insurance, started saying, of course, Sunu is about 6 naira something, but it was 30 kobo within the same 1 year. It was 30 kobo. Imagine something that was 30 kobo, 50 kobo, is now 6. Now, how many percentage is that? I don't know that calculator will calculate that. Is if you times by 2, 30 kobo is 60 kobo. If you times by another 2, 1 naira, You times by another 2, times by another 2. You continue to multiply before you get to 6 naira, right? Now, they suddenly came out and said, based on Tinubu pronouncement that he want to make the economy, somebody just posted the 52-week range of Sunu, 1 naira to 11 naira. Can you imagine investing just one? Remember, I will say 52 weeks is not like January to December. Anything that you buy within the year, while the year is still running, is another 52-week range. That 1 naira you saw is something that was a couple of months ago. Very early in the year, last year was 30 kobo. But even if you didn't see it at 30 kobo, you knew when it was just barely 1 naira, you got it. You sell at about 10 naira. I mean, that's money within a year. So what was driving it was the pronouncement that, Tinubu said the economy, they want the economy to, the GDP of Nigeria to be at least $1 trillion. And a key part of it was the capitalization policy of CBN for banks, international banks, 500 billion, national bank, national license and authorization, 200 billion, sub-national, 50 billion, if you are non-interest, 20 billion, and all whatnot. So a lot of banks went into the market, and unlike before, they insisted that your capital that you want to raise should be fresh fund. So you're not going to be using your retained earning. So if for some banks like Zenith had over 1.9 trillion retained earning. So if it was allowed for banks to use their retained earning, which by accounting standard, by regulation, is part of your capital, and what happened in retained earning is just those portions of your profits that you did not give out as dividends. You decide to plow back, so you retain them because of future capital increases. So before Cadaso, whenever banks want to talk about their tier 1 capital, they add retained earning. But Cadaso redefined it and said, okay, I want you to raise capital, but don't use your shareholders' fund. Go and use fresh fund. Go to the market. It was a creative monetary policy. One, they were looking at so many money in the economy. Inflation was galloping, running out of policy instrument control. So they thought by pushing the bank to raise money from the economy, they're going to be mopping up the broad money and the narrow money, put them from out of the market, and reduce the money in circulation, probably reduce inflation. Wrong policy with insights. Productivity is the solution. You need to make more products. Once you push in more products, and there are so many products in the market, naturally price will drop. And that's what Tinubu was saying in this media chat. When they were saying, are you going to control prices? Are you going to do, market control? He said he doesn't believe in that. So demand is pursuing few goods. So prices are going up. I will deal with the supply side, pumping a lot of supply, and then demand and supply will generally, mop up anything that is in the market, and price will moderate. So productivity, everybody knows, is the solution to inflation. You cannot use 100 people trying to buy something from only one person, and you don't expect price to go up. But assuming the people that are bringing the product are 1,000 and the buyers are 100, naturally price will come down. So supply must have to go up before price will come down. So if you like, you borrow money from IMF, you pump in, whatever, you will not, experience have shown, benefit of insight have shown that even the mopping up, Zenith Bank was oversubscribed. I mean, they raised about 300 and something billion. GT Bank did about 50% subscription. They went back to the market through a private placement. You have Fidelity Bank being oversubscribed. You have so many banks coming to say they've raised the money. They've mopped up trillions of naira from the economy, yet inflation did not moderate. We show that at the time they were in the boardroom planning those policies, they believed that by mopping up money, inflation would moderate. But no, the basket that form the basis of calculating the consumer price index shows that we are having shortage. There is no products in the market. We are importing almost everything. So imported inflation will continue to pursue us on that are doing research, PhD, CFA, and all whatnot. We have quite a lot we can analyze, but we are investors. how we take advantage of what is happening is what concerns us. So coming back to insurance, when the banking sector recapitalization was almost rounding up, NICOM, pursuant to the policy of government to have a $1 trillion economy, said that the insurance company today cannot absorb any shock, so they need to capitalize. Remember, before now, there have been 2 attempts to capitalize the insurance company. One of them, they went to court and said the timing was too short. They were playing around, but they knew they were all going into extinction. They need to capitalize. So you have the likes of, Royales, you have the likes of Uninvest, you have the likes of Continental Insurance, you have the Custodian, you have Sunu, you have Green, Guinea, and all whatnot. So when they announced that, what happens? If you are following the market, started mopping their stock. What does that indicate to you? When the owners are buying back their stock massively. So Guinea Insurance, that were all the insurance, almost all of them, apart from the big ones like Custodian, like Continental Insurance, like NEM, like Massad, Asa Massad, that were already average close to 10 naira, above 5 naira. Almost all the medium insurance company were selling at 30 kobo, 50 kobo, almost all. Royales, 30 kobo, Sunu, 30 kobo, Guinea, 30 kobo, Uninvest, 30 kobo. Name all of them. They were all around that 30 kobo. So we started seeing, analysts started seeing that Guinean owners were mopping up. They were mopping up. So the stock were getting scarce. It was going to 50 kobo, going, cross 1 naira, right? The same thing was happening to Sunu. Sunu just started running. They were rushing, mopping up. It got from 30 kobo to 1 naira, from 1 naira to 11 naira within 1 year. So what was driving it? Nobody wants to be bought over. Everybody wants to make their prices a bit more expensive so that even if a bigger player wants to buy them over, the owners will say in the market, my prices are valued at 11 nairas and I have a billion share in issue. So, merger is exchange of, you absorb now by exchanging cash for shares. So, okay, I want to buy you over. Okay, I have 1 million shares in the market. Each price is 11 naira. As against, I have 1 million shares in the market. Each price is 30 kobo. So, settlement, not necessarily fundamental, because most of these companies that were jacking up their prices based on the pronouncement of government, it's not like they are fundamentals in terms of profit, revenue doubled. It's not like they doubled. Their premium did not double overnight. Their, broad money did not drop overnight, but those settlements were driving it. So they didn't want to be, there was the fear that there will be mergers. Of course, there will still be mergers. They will fear that some of them will forcibly acquired. Imagine having a share in the market at 30 kobo. You remember what happened between Otedola and Transcorp? And what led to Transcorp repricing their shares today? Transcorp is about 16 naira. Remember, there was a time, gradually, Otedola emerged as almost owning close to 30% or thereabouts, appeared in the board until big conglomerates. They've come out with power. They control close to 40%, 50% of Gencos. Whatnot, AFA. Now, despite all those acquisitions and the size of Transcorp, they were still in the market at barely 1 naira 50 kobo. Otodola saw and smelled blood. He was mopping up from behind, mopping up. Before you know what happened, he came and said he's a partner of Transcorp and appeared in the boardroom. And many of you know the story, right? You know the story. Gradually, there was an arrangement behind, and Elumelu quietly settled in with some billions, and the man exited the company. And as soon as he exited, Elumelu quickly reconstructed the share price of Transcorp and came out at close to 100 naira. So it's like saying, I won't make that kind of mistake again, because if your stock is so cheap in the market, you are inviting a forceful takeover. So those calculations played into what was happening in Sunu, Guinea, and all whatnot, right? And immediately the regulator reclarified their pronouncement and said it's going to be a gradual approach. It's not going to be one swoop type of capitalization. There was a moderation in the panic and in the sentiment. So there are many filter criteria. Like I mentioned at the outset, it will be difficult for the 45 minutes an hour program to, either make some of us CFAs or analysts or stock specialists overnight. Even those of us that are talking, we are still learning the market, we are still understanding, we are still picking. Yes, we are vast, we seem to know some various capacity, KPIs we look at, but it's a market we continue to understand because of various, issues. So I will round up by saying that. I'll round up by saying that. I think there was some interference. I don't know whether I was being heard again, but whatever. I will conclude by just saying that for some starters, there is always this confusion. Do I buy penny stock or do I buy established stock? I would say for starters who are just about coming to the market, I would say you put your capital in fixed income and use the coupon to invest in equity. For starters who are just entering the market, I will advise your starting would be, because I talk about a portfolio, your portfolio will start with just two securities, fixed income and equity. Fixed income like treasury bill, government bonds, sukuk, then equity will come as secondary. So beginners who are among us, my first line of approach is start with debt instruments, federal government bonds, or treasury bill. Treasury bill is just 1 year, but you want to beat inflation a bit by going into maybe government bond that is about 3-4 years, like 2029 bond I mentioned is about 19.3. 19.3 is lower than inflation, but if you use the coupon properly, you beat inflation for sure. And it's not likely that if you double your money in 3.5 years, it's not likely that inflation of 34% will be 64% or 68% in 3.5 years. So you definitely will beat inflation. There are many calculations that can be done that will prove that you beat inflation if you apply compounding interest. Compounding interest could be a very strong factor. So if you are a beginner, instead of taking your entire capital, 10 million, 5 million, 20 million, starting with the equity market, I would rather you put it, lock it up in government bond. The reason being that theoretically it's risk-free. Evidence have shown that there could be some risk in gilted instruments. Ghana last year declared a default for all their instruments. They came out and told the investors, we are not able to pay coupon. You will not lose money, but they ask for restructure. You want to wait 3 years, let's recover, they will start paying you. It's unlikely Nigeria will have that problem because we have oil, we have crude. Our crude continue to generate revenue. But theoretically, gilted securities, treasury bill, government bond is backed by sovereign guarantee, so it's risk-free. So you want to keep your money in a risk-free instrument that will not lose your capital. Your capital is constantly there. Inflation might impact it, but if you play the coupon very well, you beat inflation. So when you get that 10 million into that 19%, and they pay you a coupon of 1.9%, you use that 1.9% to play the equity market. At the end of the period, 3.5 years from now, that is 2019, about 4 years from now, your 10 million is waiting for you. Nothing touches your principal, but you are playing the market with your coupon. So for starters who are just about entering the market, I would say play with your coupon. Use your coupon to test the market, not your principal, right? So by the time you use your coupon to test the market, you understand the trade. Some of these things I've said will become practical in reality because you'll be seeing them playing out. You will see how you were able to select some growth stock because you subjected them to some filter criteria. They have the type of product you are looking at. They have the governance structure. They have the diversification. They have all the various bottom line, 5 years financials, or whatnot. You have done all those analyses. So you subjected your coupon to those. So you are now subjected to the discipline of the market and you come out stronger because you are understanding the market. And you also have apps that tells you whether to buy, whether to sell, not necessarily following the app, but at least giving you a guide of the community and the sentiment around investors and all whatnot. So you play with your interests, not your principal, for starters. Who are already grounded like me, who are already we are having for those who are already grounded like me, who understand the market. I think today you probably have confirmed some of your strategies. Maybe you want to modify some of your strategies, but I will tell you, bring in more money into the capital markets. Bring in more money to the capital markets. And for those of you that are already experienced, don't be too quick to buy when the bull run is driven by dividend signaling. A lot of people make that mistake. Everybody know, and most of the companies in the market, not 100% company, but most of the companies in the market have December as their end of year. And for all the dividend stock that are under your universe that you are reviewing, many of them will pay their dividends or declare, not necessarily pay, but they will signal and declare dividends between January to March. And because of dividend signaling, prices will always go up. Prices will always go because smart money will come to take advantage of those dividends. The moment a company publishes its final report and inform the market that they are going to pay dividends, they declare dividend and that they're going to pay dividend on XYZ dates, the S dividend dates, the qualification dates. Within that period, smart money like portfolio investors, like the pension fund, like the ROSA fund, like all that smart money from abroad and all of them will come in. Europe interest is almost negative. So if they see a big company that promises to pay dividends yield of about 12, 30, 40, 15%, they will come in. Portfolio investors like pension funds and those custodians, they are also regulated by their own PENCOM. They must invest. One of the compulsory areas that they classify investment into category A, category B, even when the category A is not the highest yield, usually meant to invest some portion in those companies. Fixed income, you must invest. If you want to invest in equity, you must only invest in companies that are paid dividend consistently for 5 years. They may be seeing a company that can give them capital return on your ROSA account for times 100. They won't go there. They will go for the one that will give them just 20% because of regulation control. So because of those factors, which is not known to so many investors, you will see that because there is signaling, dividend signaling will make price to be going up. A lot of people will come into the market at that period. And as soon as they pay that dividend, prices will start crashing because there's no more activity. Smart money have earned the dividend they have pulled out. So they will now see that from April, May, there will be continuous decline till close to third quarter report again. A lot of those investors will be panicking. You entered at the wrong time. You enter, if you have already entered and you want to take advantage of dividends, you make a decision. What are the decisions? If I enter and my capital appreciation is 100%, but the dividend yield is 20%, you want to ask yourself a question. 100%. It means if I earn this 20% dividend, I need 5 dividend years to make this capital appreciation that I have made. Why don't I take out my capital appreciation, forget about the dividends, collect my 100%, and come back to that same company when the prices crash? A lot of people don't know when to come out. They don't know when to go in. So buying during dividend signaling, experience have shown, is a wrong strategy, except you bought that stock very, very, very cheap. Imagine you bought Zenith when it was 9 naira. Zenith is now about, and you are looking at the percent. Capital appreciation is 100%. It takes me just about 2 dividends. I have made my capital have not sold. So I continue to make this 50-something%. And if they increase dividend, it can even go to 60%. So when you buy a stock very, very, very low, and the dividend yield is high, very high, that is when you will not take advantage of capital appreciation. But when you bought a share and the dividend and the capital appreciation is almost a multiple of your dividend yield, you know that you need of dividends is a whole different topic, but it's usually that. So my beginners today, put your capital in fixed income and play the market with your coupon and your interest. For those who are already deep into it, buy red in your percentage change, which show that you are losing money the more you buy. Except you was not subjected to the right filter criteria and it was not well selected, that you cannot cut your loss. Take Arade, for instance. Arade was a company that came into the market to and something. People did not enter. Arade grew to close to 700. Now they are dropping to 500 and something. This is the time to start. When you drop again, you buy. When you drop, just buy only 50,000 units eventually. Even if it's just 50,000 units eventually. Arade is a stock 1,000 naira. 1,000 naira easily. So these are for people that are already in, who knows that they burn their fingers, they know how to come back and know what not. But what we call burnt your finger is because you sold. If you did not sell, you probably would have started making more money. What you do when the stock is very, very low, what you bought at 10 naira is now 1 naira. Pack many of them at that 1 naira so that your average cost will come down. Only for stock that were initially selected based on the filter criteria. But for stock that were done blindly, you want to cut your loss. But for stock that were bought properly, you want to accumulate when there's blood in the streets. Ladies and gentlemen, I want to thank you very much for your time. It's been a pleasure taking out this period to discuss and share my ideas and thoughts with you. I hope that as we continue and we continue to learn from each other, we can do well. If some of the things I've said today make meaning and you are happy, and if it helps you to create more wealth, I would have been the happiest person because I have been able to contribute to your success story. I thank you. Thank you very much.
Thank you so much, Mr. Burman. This was explosive, right? And it's just for me, I've been doing this now I've been in the market for close to 10 years, and you are bringing another level of, what you have just shared tonight is another level of information. Of course, I already have a lot of information around that, but you have brought more like an upgraded version that I'm actually, even as a trainer, I will now go and start executing. Guys, you would agree with me that this has been one of the best sessions that we've had so far, right? A lot of you, if you paid attention to the training you took, your 1 month training, you will see that I shared a lot of these things. I share the same sentiment. And one of the goals that I set for myself is to intentionally, bring people like Mr. Burman into my network, right? Some of you are sort of, I don't want to say that word, flabbergasted, because of the kind of figures is mentioned in 100 million, 500 million, 10 million, and then he has to slow down to force himself to use 10 million. That's how it is. It is just money. It's not a big deal. And you need to start working with that kind of mentality as well, guys. All right. I won't be able to take questions, right? Because our time is fast spent. I don't want to also keep him longer than necessary. What I would advise we all do is the session is recorded. I would send it to our Google Classroom so that you can have access to it. I want you to please listen to it again and action it, not just listening. Listen to it, let it be part of your life. If you have to set your alarm that for the next 2 weeks, you want to sit on it and understand all the information. We have just delivered to you gold mine. So please take advantage of it. Mr. Bruman, thank you so much. From the bottom of my heart, I truly, truly appreciate what you have done for us tonight. This is not going to be the end. You would hear from us again. We would invite you again to come share with us. And our success story will put you on the list of people that impacted us. Thank you so much, sir.
Thank you so much. Thank you.
All right.
Thank you.
Thank you. Everyone, thank you everyone for your time tonight again. And enjoy the rest of your evening.
Thank you very much.
Thank you so much. Thank you so
Thank you for the
much.
exposure.
Thank you, sir.
Thank you, sir. God bless you, Mr. Shay.
Thank you so much.
Thank you so much. We are grateful.
Thank you so much, sir.
Thank you for the value. God bless you, sir.
Bye.
Thank you, sir.